Bless Squad, what's going on with y'all, man? It's your boy, Blessed Applesauce, the Bless Show, with another video here on Blessed to Invest. And today I want to talk about a very popular strategy called the Golden Cross. This strategy you've probably seen on a lot of YouTube videos talking about, okay, this is the perfect strategy. The strategy works 80% of the time. The strategy is perfect for any swing trader, day trader, whatever. And it's true. It's a very simple, effective strategy for anybody. Again, pause, hold up, hit the like button. Make sure you hit the like button. Also, sub down below. Can't forget that. But the strategy is very popular because it's so simple. And what is it? All you're doing is looking at this particular EMA line here. This is the 50 EMA, and then you're looking at the 200 EMA, and then you're waiting for them to cross. And once they're crossed, you're going to take a position in the given direction. So once the EMA crosses, the 50 EMA crosses below the 200 EMA, you're going to take a short position and ride the stock down. If it happens in reverse where it comes above, let's say, let me zoom out a little bit so we can see an example of that. If it were to cross above in this scenario right here, so once it crosses above, that is a signal to take it long. You would trade this long and you would ride this trend in the bullish direction. So there's a lot of drawbacks in this strategy that a lot of people don't talk about. I want to discuss them here, what you can do, how to avoid them, and how you can set yourself for success in the strategy, because it is a very effective strategy and a great strategy for people that are just getting into the trading game. But I want to make sure y'all doing it correctly and y'all understand exactly how to manage the strategy properly. So let's get into it. So the first thing with this strategy, it's very simple, because once it crosses, boom, you get into the trade, everything's good, and you're riding the wave basically. So in this strategy, the biggest downfall when it comes to this strategy, I'm going to show y'all this particular stock right here. I'm going to lower the time frame to an hour. All right, 1 second, guys. All right. So one of the issues with this particular strategy here, as you can see, sometimes it gets into these scenarios where you see how it crossed here, it crossed here, it crosses over here, and it crosses multiple times, but it never picks a particular direction. This is one of the dangers of this strategy. So let's say you get in a trade right here, you see the trade signal, boom, you're like, okay, let me get into the trade, life is good. You hop in right here, and you're hopping in on this particular day right here. Let me box this. So you hop in on this day and you're in this trade, and then all of a sudden it reverses on you, it hits your stop, it runs your stop, and it's over because it's not in a trending direction. That is one of the pitfalls of this strategy. Same with this one right here. It crossed right here, so that's one of your trade signals. Boom, you get in right here. So you think you're going to short this thing, and it's going all the way down, and then all of a sudden it reverses and comes back up. And that is one of the downfalls of this particular system, is you need to make sure that the market is trending in your favor, because when it's consolidating, this strategy can be terrible. When it's consolidating, it's going to run every single stop. You're going to be losing a lot of money. You're going to be stressed because you cannot find that overall trend. And how do you figure out how to avoid that? The best thing to do is to zoom out. So let's say you're trading on a 4-hour time frame, or you're trading on a 1-hour time frame, or if you're even trading on a daily time frame, depending on what type of trading strategy, trading horizon you're looking at. Try to zoom out. You want to zoom out, and you want to look at the overall trend. So what is the overall trend telling you of this stock? This stock is overall down on a daily chart. The stock price is under the 200 EMA. and it's just kind of choppy. It's not really picking a true direction. So when you look at this and you're looking at it on the daily, and you zoom in and you look at the 1 hour chart where we saw a particular trade signal, you want to think to yourself, okay, is this something I want to trade? If the trend is down, do I want to be taking this uh, long on here? Not really. So if the trade is down, I recommend you trade it short only. So let's say you find a trade signal on the 1 hour chart that say go short on this particular play. It crosses over, says go short, and then you zoom out and the stock is also trending down. Then take the trade in the short direction. If the trend is up and is giving you a sell signal, don't take the sell signal. Just hold off, wait for another play, wait for another opportunity. And that's going to allow you to avoid a lot of situations where it's not trending in your favor. It's a little choppy. The market is being a little indecisive, because the biggest issue with this system here is you want to avoid indecisiveness. This strategy is going to set you up for a lot of indecisive candles, a lot of just consolidation, and you want to get rid of that as much as possible. Of course, you're going to have your losses, but you want to avoid that as much as possible. Next, the next thing I want y'all to make sure y'all do is add an additional indicator. It's really going to save y'all a lot of time if you don't fully rely on just the two golden crosses to occur. If you add some market structure, so let's say we throw some support and resistance lines on there, which I recommend everyone to do no matter what strategy you're trading. If you throw some market structure on there, you can see this thing is kind of in a channel right now. Like, it's not really picking a direction. I know this was a couple of months ago and it's starting to trend up a little bit, but you can see that this thing was just a stock to play on the market structure side. This was not a trending type of stock. It was consolidating. So when you see market structure like this, you want to identify it. You want to identify it and understand that it's probably not going to break out of this particular market structure. It did right here. This was probably some news. Well, yep, as you can see, there was a big earnings day, and it broke out of this market structure. Well, on an average day, when it's moving like this and you want to take a trade signal within this market structure, 9 times out of 10, it's going to be a loss. It's going to be a failure, and you're going to be frustrated because you're wondering, why won't the stock trend? And it's because you're trading in a channel. So avoid the channels, understand, and look at the market structure and identify it that way. And also add an additional indicator that's going to give you some type of evidence where this market is trending. One indicator that I do recommend is the MACD. This is a very good, and whoops, it's not remove all studies. One indicator is the MACD. Let's pull that up. And this is really good because it shows you where the buyers or sellers are. If it's a short bias right now, if it's a long bias, and it helps you determine what side you should be taking. So right now, this is really strong red. So maybe you want to go short on this. If this was in a scenario where the trade signal occurred for the golden cross. This one right here, as you can see, this thing is just very indecisive. You see it's very weak green, weak red, and it shows, even if you're looking at the market structure, it shows that it's in a channel. So this one, here we go. We have a lot of stronger green. You see the difference in the green, the difference in the red, how strong the red that is. So that's showing it's in a trending market. This one right here, again, is showing it's in a trending market. This one right here, nice and strong, is showing it's in a trending market versus this right here where it's just very weak. So make sure you're getting into situations, use an additional indicator, use some market structure to identify, okay, is this in a trending direction? If it is, be willing to take the trade and take the trade signal. Next, you want to look at another pitfall you want to look at is trader closer to the EMA. Let's go back to the 1 hour chart because it was a great example of what I was referring to, trading closer to the EMA. So when you're looking at these particular stocks, a lot of times the golden cross is going to be a lagging indicator. The golden cross happens, as you can see, it happened right here, but you're not able to get into this play as soon as the golden cross occurs. It's not going to pop up with your scanner, and it's not you're not going to be able to take this play overnight. It's just not going to happen. You're probably going to get into this play toward the end of the day or right in the next day. So looking at it, let's put this right here. You're probably going to get into this play around here, around this zone. You're probably going to get in like right here. And the one issue with this, it may be harder to put a stop loss when you're trading when the price is so far away from the cross. You see where the cross happened right here, and then the price is all the way down here, and you're trying to get in right here. It's better off getting into a play where the cross occurs where it's closer to the price. So this, and I'm going to show you an example of what I'm talking about in a second. But when the price is closer to the cross, because you can put a stop loss there. You can put a nice healthy stop loss a lot closer. It's going to give you a better risk to reward ratio. It's going to give you better returns on your investment. And you're also not going to be sitting in these trades as long as you would if you were to take a trade like this. So let's say you take this trade, you put your stop loss all the way up here or all the way up at the top here. This thing may not stop out ever, really. But look how long this took to do anything. If you got in right here at $12.50, it's hovering around $12.50 for a very long time because the move basically has already been made. And then you see this reversal that occurs. So let's say you put a stop loss here. You're in this play for a month, over a couple of months before this thing even hits a stop loss. So be wary of that. Don't get into these systems where the market isn't trending in your direction, and you're watching chop because it kind of goes down in your favor a little bit. It goes down to here. It took 11 days to get down there. Take the 9%. Maybe in this scenario, you take it and understand it's probably going to be a shorter play because the trend, the direction has already been made short heavily. But just to avoid all that, just make sure you're taking a trade where it's closer to the price is closer to the cross. And this is a perfect example where the price is much closer to the cross. You see how close that is in comparison to the one we were previously looking at, where this one is super far away, nowhere near the 50 EMA or the 200 EMA. The price is just gone. The move has already been made. Take a trade where it's a little closer. It's a little closer here. You see how close that is. Price is still there. And you can put a stop loss a lot tighter. You're going to be able to put a lot more risk on. So let's say you put a stop loss right here, for example. You get in on this cross. You get in on this day. You have a nice tight stop where you can have a good risk to reward ratio. And this thing is already trending in your direction. Why is that happening? Because the move hasn't already been made. People are slowly seeing this move. 90% of the move hasn't already occurred. So when you're doing this, make sure you're trading these golden crosses a lot closer to the EMA and not during earnings where 90% of the move happened, you missed the move, and you're sitting in the trade for 60 days and it doesn't hit your stop loss and you don't know what's going on. You're just kind of consolidating, basically. And another tip I do recommend, and you really do have to test this based on your strategy, is moving your stop loss a lot with these systems, because the same way as you've seen right here where there's going to be a lot of chop that occurs, you want to make sure you're minimizing the chop that may happen on these particular trades. So we have a little bit of chop here. There's just chop, 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 chop right here, and it's just chopping around, and there's no real direction on it. So I do recommend, once you get to like that first, let's say you take half of your risk. Let's say you get in right here, and this is a 7% stop right here. Once you get 7% up on your position, start moving your stop loss up. So in this scenario, let's say 7% is right here. So boom, 7%, you got that in a couple of days. How long did that take you? It took you 12 days. Move your stop loss up to break even, so you're not losing any money anymore. And then Once it gets to like 14, then you can move your stop loss up again. So you're locking in some profit. And I really recommend this just to, one, it psychologically helps you where you're just consistently locking in profits. And two, it avoids a situation with a lot of times in these golden crosses where you're sitting in a stock that isn't trending. The goal of golden crosses is to understand the trending market, how to identify the trending market. The MACD indicator is a good example of how to find the trending market. The EMA, you can add a secondary EMA to here to identify what the trending market is. But the goal with golden crosses is to get into trending markets and not markets that are flat and stagnant and basically chopping around like this. You want trending stuff. So let's pull up the SPY as a great example, because that market always trends in a fun direction. I know right now we're in a bear market right now, but we did have a couple of years and the SPY was just trending. Let's pull it up. Let's do a 4-year. Here's the great example right here. This was perfect. Get in right there. It's trending into your direction. Life is good. You got in a great price. You can put a stop loss basically whenever, because it never touches your entry at all. And it just moves. It moves in your direction. That's what you want to see out of your golden cross strategies. Also, with these systems, I really don't recommend set a target in mind, set a reasonable target. So put your market structure around and understand, okay, is it reasonable to get to this 2-to-1 ratio? Understand that. But I really recommend for these strategies, have it set up where you can leave some money on the table for it to run 50%, 100%, 200%, 500%, crazy stuff like that, because that's where you're going to get your big gains out of these strategies. And that's where people make a lot of money with these systems, letting some of their profits run. So let me know down in the comments below if you have any questions about this strategy. Is this a system that you're going to use? It's a very simple system. Trade the cross, set your stop loss up, let this thing run, make sure you're in a trending market, and you should be just fine. Let me know in the comments, though, if you have any questions. And that's going to wrap it up. It's me, your boy, Blessed Applesauce. Stay blessed. And I'm going to see y'all next time on Blessed to Invest.
Just to see tomorrow is a blessing. Stay prayed up is the message. Everything about a nigga blessed. Everything about a nigga blessed.